Is Rivian a buy at $13 per share? And if you want to build indestructible generational wealth, is Rivian a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis of Rivian stock based on their recently reported Q1 25 results and Volkswagen's new $1 billion cash infusion. I think Rivian is a great tactical investment, and at $13 per share, I have a buy rating on Rivian stock. In my research, I discovered 7 things that got me very excited and 6 red flags to watch out for with Rivian. So what did I discover? What's my value for Rivian stock? And what's an ideal entry point should you decide to become a Rivian shareholder? I'm Ken Freeman. I have 20 years of Wall Street experience in investment banking and hedge funds, and I train analysts at the top banks on Wall Street. In this video, I will cover Rivian's recent results and what everyone is missing, what I think about Rivian stock and what my analysis uncovered, what Wall Street's smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. Are you an investor in Rivian stock? Why or why not? Let me know in the comments below. Rivian released 1Q25 results that beat estimates, and they achieved their second quarterly gross profit in a row. Let's cover the red flags first. Rivian's Q2 handoffs tumbled to 10,661 vehicles, a 23% drop versus 2Q24 last year. As a result, Rivian has decided to revise its delivery outlook downward to 40 to 46,000 vehicles in 2025.
So we have revised our delivery outlook to 40,000 to 46,000 vehicles.
Management admits Q2 production was limited while the Normal, Illinois plant is retooled for 2026 models. Lost output has to be ramped up later, never easy in auto manufacturing.
We remain on track with the expected shutdown to both our consumer and commercial manufacturing lines in our Normal plant for approximately 1 month in the second half of 2025 to prepare for the launch of R2 and Normal in the first half of 2026.
Free cash flow stayed deep red at minus $526 million in Q1, even after 2 quarters of positive gross profit. Cash cushions don't last forever when the furnace runs red hot. Bottom line losses remain hefty. Q1 net loss was $541 million. Turning gross profit into real earnings is proving harder than the headlines imply.
Our adjusted EBITDA losses were negative $329 million as a result of the ongoing investment we are making to develop R2 and our key technologies, as well as the continued growth of our sales and service infrastructure and organization.
The cheaper R2 SUV won't see production until early 2026, leaving a long gap where pricey R1S must carry the load. Any unexpected delays would push profitability even further out.
We intend to operate R2 on a single shift of production for the majority of operations in 2026.
As of 2025, buyers no longer qualify for the $7,500 EV tax credit on Rivian purchase, erasing a key pricing lever just as customers hunt for bargains. Here's what got me really excited. Rivian just posted its second consecutive quarter of positive gross profit, $206 million, showing its cost-cutting drive is starting to pay off. 2 green quarters in a row is the first real proof that the company can scale.
I'm excited that Rivian delivered a second consecutive quarter of positive gross profit, with a gross profit of $206 million. This reflects an outstanding effort from the team and a continued focus on cost and operational efficiency.
Clearing that profit hurdle triggered a $1 billion equity check from Volkswagen on June 30th, fattening the new war chest without new debt. Strategic cash plus tech-sharing credibility all in one stroke.
Rivian has now met the gross profit milestone with Volkswagen Group and expects to receive $1 billion in funding at the end of June.
The R1S is now the best-selling electric SUV over 50,000 in the US and tops California's greater than 70,000 charts. Proof the flagship owns its premium niche. Winning the high end of the EV SUV market keeps the brand hot as cheaper models arrive.
In the first quarter of 2025, R1S remained the best-selling SUV with a starting price over $70,000 in California. And the R1S was the #1 best-selling electric SUV in the United States with a starting price over $50,000.
The midsize R2 SUV will start around $45,000, putting Rivian into the mainstream price band where most new car buyers live. One product more than triples its addressable market.
With the expected scale of R2, our investments in this technology begin to build a structural cost advantage, which is a core element of delivering R2 at a price point expected to start at $45,000.
Management says they're heavily reducing inventory and incoming material days on hand by rolling out lean processes and opening a new supplier park. A trimmer supply chain frees working capital and cuts waste.
we are heavily reducing our inventory and incoming material, the days on hand, not only in the plant, but as well the flows that are coming from the suppliers to our plant in the cross docks or whatever is on the trains or in the trucks.
On top of that cash pile, Rivian can tap $3.5 billion from the VW JV, $6.6 billion from a Department of Energy loan, and a $1.3 billion revolver. Expansion and scaling won't be a problem.
In addition to this, we expect to receive up to $3.5 billion of incremental capital associated with our joint venture with Volkswagen Group, up to $6.6 billion loan from the Department of Energy associated with the build-out of our Georgia facility, and have access to $1.3 billion of availability under our ABL facility that we recently amended and extended through April 8th, 2030.
This is what everyone is missing. Rivian still sits on $7.2 billion of cash and short-term investments, giving ample runway to fund R2 and autonomy research and development.
As of March 31st, 2025, we had $7.2 billion of cash equivalents, and short-term investments.
And for those concerned about cash burn, it has actually improved from year-end to Q1 2025, going from 3.5 years to 6.6 years of runway. When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
No, thank you.
That is exactly what you're doing when you buy a stock without understanding the company's 3 financial statements. If you want to value companies just like the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Rivian has some very unique debt features, and I can't wait to show you. At the end of 2024, Rivian had $7.7 billion of cash and short-term investments. This is what made up the bulk of their more than $9 billion of liquidity. We covered this earlier in the cash burn analysis. And the company has been net cash in their entire existence as a publicly traded company, which creates tremendous flexibility. Property, plant, and equipment is the engine for future growth. Many startups go too hard, too fast with this, but not with Rivian. There was a big ramp after the IPO in 2021, but growth has been steady and methodical. This type of scaling ensures that liquidity is preserved and cash flows are consistent. While the company has $4.4 billion of debt, it has a very unique structure. $3.2 billion of the debt consists of convertible notes, and these notes have PIK or paid in kind, not cash interest. This interest adds to the balance, but is not a cash outflow, which gives the company more financial flexibility. So what's the takeaway? Rivian is an early-stage growth business with a conservative balance sheet and a promising future. The income statement shows us if a company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue has grown over 90x from 2021 to 2024. Rivian has already delivered 30,000 vans to Amazon and 70,000 more by 2030. And the Volkswagen partnership plus a recent agreement with HelloFresh will provide continued high double-digit growth. While gross profit is negative, it has been improving, and it was positive for the last 2 quarters. Software and services has been the star of the show, generating 55% of the total gross profit in 1Q25. The company has done a phenomenal job at cutting costs, and gross profit is projected to be positive moving forward. Interest income has been greater than interest expense for the last 3 years. This is because the company has been net cash, meaning cash is greater than debt, so the interest generated from the invested cash is able to cover the interest expense and leave some money left over. So what's the takeaway? While we do not see positive EBITDA or net income for an early-stage growth company, they are showing improvement every single quarter, which is a very positive sign. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash, making this positive, not losing cash, which would make this negative. While free cash flow is negative, we see the same improvement since 2022 that we saw with gross profit. Rivian has actually achieved positive free cash flow in 4Q24 of $856 million. While it was not positive in 1Q25, this was mainly due to an increase in inventory for the R2 launch. CapEx has been very reasonable despite being a car manufacturer. Since the IPO in 2021 through 2024, the company has very conservatively managed its capital expenditures, which has boosted the improvement in free cash flow. Even over the last 5 quarters, we have seen a smooth and steady CapEx allocation. Rivian has taken a page out of the Mag 7 playbook. Over the last 2 years, it has generated over $4.5 billion from invested cash and short-term investments. So what's the takeaway? While we aren't surprised by the negative cash flows of an early-stage growth company like Rivian, improving financial results since 2022, a newly announced partnership with Volkswagen, and increasing production and demand all mean a brighter future for the company. So what does this all mean for the valuation of Rivian stock? Let's cover that next. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we can take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to value companies like we do on Wall Street so you could build generational wealth, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you can check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get a total enterprise value of $15.9 billion. We strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. That gives us an intrinsic equity value of $18.6 billion. Divided by the current shares outstanding, we get an implied share price of $16.26 compared to the current close of $13.20. That's a 23.2% discount, which is a buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides a margin of safety. So what does Wall Street have to say about Rivian stock and how can that impact your portfolio? Let's cover that next.
Let's hear it.
Analysts are cautiously optimistic on Rivian, influenced by factors such as delivery forecast policy changes and market competition as we await the introduction of the R2 in 2026. Barclays has an equal weight rating with a price target of $14. Barclays reiterates that upside is capped by tariff costs and a slow ramp to 2026 volume, even as management sharpens manufacturing efficiency. Cantor Fitzgerald has a neutral rating with a price target of $15. Cantor maintains a wait-and-see stance following Rivian's Q2 delivery miss. They say that the extra VW cash cushions 2025, but free cash flow break-even remains several years out. Jefferies has a hold rating with a price target of $16. Jefferies cut the stock on slower backlog growth and persistent average selling price pressure, arguing that competitive price wars could squeeze gross margin. CapIQ shows me how other analysts on Wall Street view the company. 26 analysts cover Rivian on Wall Street. The target price ranges from a low of $705, which is a 47% decrease, to a high of $23, which is a 74% increase. The average is $15, which is a 14% increase. The overall rating on a scale of 1 to 5 is 2.5, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do own a position in Rivian, and I am a believer in the company. It's currently my 3rd smallest position in my portfolio at a weight of 4.6%.
Sounds interesting.
If you decide to buy Rivian, I'll tell you exactly how to build a position, which I'll reveal shortly. Rivian has already rolled out hands-free, eyes-on highway driving for Gen 2 vehicles with eyes-off capability next. The in-house tech stack is reality, not fantasy.
We recently launched hands-free, eyes-on driving for our 2nd-generation vehicles for highway driving. And this is the very start of a steady stream of ongoing enhancements which we plan to make. We are focused on delivering turn-by-turn autonomy as quickly as possible while expanding from hands-free eyes-on to hands-free and eyes-off. We believe eyes-off functionality and autonomy in urban settings will enhance the overall product experience.
Rivian's Adventure Fast Charge network boasts over 99% uptime, only one of 2 U.S. networks that reliable. And Rivian's charger network was recognized by Consumer Reports as having one of the best user experiences.
But amazingly, we believe our network, along with Tesla's, will be the 2 largest charging networks in the United States.
A proprietary revenue-generating grid eases range anxiety and locks in loyalty. Q1 saw a 3.3K drop in cost of goods sold per vehicle, driven by efficiency gains and fixed cost leverage. Lower COGS opens the path from gross profit to real earnings.
In Q1, we saw a $3.3 thousand per unit improvement in COGS. And that was despite the fact that we had a higher concentration of R1 deliveries in Q1 relative to Q4.
86% of Rivian owners said that they would buy a Rivian vehicle again, and it was the only company with a 5 out of 5 satisfaction score. Edmunds rated the R1T as the top-rated electric truck for 2025. They even stated that, quote, the R1T stands head and shoulders above every other electric pickup on sale right now. Rivian hit a 52-week high of 1886 in early July of 2024, and it's down 30% since then. The 52-week low of 950 was in the fall of 2024, and it's up almost 39% since. There will be plenty of opportunities to buy Rivian stock in 2025, and I don't expect any major price spikes since expectations are muted as we await the R2 launch in 2026.
Let's just wait and see.
Rivian is a satellite or tactical position in my portfolio. As it becomes more profitable, its intrinsic value and market share will grow. My model shows a value of $16.26, which is a 23% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Rivian is a buy at current levels, and I think a good entry point is in the $12.50 to $13 range. If you decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. If you like this and want to see another in-depth stock valuation, check out my Lululemon video here or my Constellation Brands video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.